Okay, so if you wanted insider information from the banks about how bad this is about to get in terms of a recession, in terms of a depression, then you need to listen in on this video as I go through the yield curve and explain what the yield curve is and how we can use it to predict what is going to happen coming into 2023 and beyond. So first of all, I'm going to bring up this chart here. This is essentially the blue line is the 2-year government bond yield and the orange line is the 10-year government bond yield. So I'm going to explain this really quickly and hopefully in a way that most people can understand. And if you don't understand it, I highly recommend that you rewatch this part of the video until you do understand it. So essentially, imagine that you go to the bank and you buy into a savings bond. And let's say in this case, it's a 2-year savings bond. So the bank is wants to basically you're basically going to lend money to the bank for 2 years and the bank is going to pay you, let's say, 2%. Okay? So let's say also they have a 10-year savings bond. So you're going to lend your money to the bank for 10 years and the bank is going to pay you 3-4%. You would expect because it's longer, there's more risk. So essentially what happens is that is like a normal yield curve where you have the lower end where you're lending money for 1 month, 6 months, 12 months, 18 months, 24 months and beyond. As you go longer, the yield goes up that you expect to receive because you're lending out your money for longer. You're taking more risk by lending to the bank. So it's extremely predictive, and basically the yield curve, what I'm showing you on the screen, is government bonds. So this is the government, essentially you lending money to the government, or in this case it's banks and large financial institutions lending money to the government for 2 and 10 years. So it's really important to understand how that mechanism works. It's essentially supply and demand market. So if the demand ramps up for people wanting long dated bonds like the 10-year bond, then that means that the yield goes down. And if the yield drops below the 2-year bond, then that is typically a good indication that hard times are ahead. It's essentially like an insider information from the banking system. It's like a window into the banking system to see that large financial institutions like banks, they think bad times are ahead. And depending on how extreme it gets, depends on how bad it's going to get, as I'm going to show you right now. So take a look at this chart. Basically, the blue line you can see is way above the orange line, which is at 3.10%, and the blue line is at 3.86%. So way above. There's a huge spread in between these two. So first of all, let's go back to when the blue line last went above the orange line, which was the last time when the yield curve inverted. You probably heard people say that a lot, and now you're going to know exactly what that means. So the last time this happened, as you can see on this chart, was during 2019. That was when the yield curve inverted, and that was because there was a recession that was essentially being predicted. Back then, economies were slowing down. We didn't know what it was going to be, but we knew that bad times were ahead. We didn't know the extreme circumstances of what was going to happen in 2020, but you knew that likely without what happened in 2020, without the cerveza sickness, you would have seen a recession anyways of some description. So it's just a case that came in and just made the situation a hell of a lot worse. So when was the last time? You're probably thinking before 2020. Well, if we go through the chart, the last time that it inverted before 2020 was in 2007. So essentially, it inverted in 2007. And you can see the spread is not that much. Now, the reason why this is so important for people to understand is because this is large players, primary dealers like banks and financial institutions, who are the main market makers, the main participants in markets like this. So they know when things are going to get gnarly, and they essentially start to hedge against that, and they start to act in certain predictable ways that we can then say, hey, they're acting in this predictable way that has happened before every time before a crisis. So we know that something bad is going to happen. Now, if you look at 2007, I want to show you that there's barely a spread. Like, it barely inverts there. And that kind of goes with the fact that the banking system was largely not impacted that much by 2007, 2008. Canada managed to move through it relatively unscathed compared to other countries. Obviously, there were still massive struggles in Canada. There were still bank bailouts that happened. But largely, the country managed to move through it relatively unscathed. And we've explained that in previous videos if you're interested in why that happened. So you can essentially then go and look at now. And if I zoom out on this chart, you can really see it. And unfortunately, we only have data that goes back to 1987. But that's long enough, in my opinion. If you go to the Bank of Canada, they only go back to 2001, and their chart is absolute garbage. This is on the Bank of Canada's website right now. So if you look at this, the spread, the blue line is way above the orange line. The spread is quite large, as you can see. It's way larger than in 2020. It's way larger than in 2007. And it's much larger than in 2000, where it barely inverted, just like in 2007. But if we go back to 1987, you can see that it got seriously inverted. And this is where things get really gnarly for what's coming in the Canadian financial system. Because if you go back and you look at the failures of banks during that period of time between around 1987 to around 1996, and I've got it right here on this website, you can see that pretty much half of the failures, so if you look at this list, you can see that easily half of the banking failures that have happened in Canada occurred during that period of time. Now, that's not me saying to you that get your money out the bank and the bank is going to go bust tomorrow or anything like that. That is not what I'm saying here, because if one of the banks got into trouble, I'm sure it would be took into public ownership. It would get a massive bailout. But at what cost would that have to your purchasing power? What cost would that have to the Canadian dollar? And those are the things that you really got to understand. And not only is this highly predictable, the yield curve, you can also look at other countries and see how inverted it is in comparison. And we know, for instance, with the United States, that it isn't as bad as it is in Canada. And the thing that I really also want to highlight is the fact that this yield curve gets more inverted every time they hike rates, meaning that the rate hikes are having a negative impact on whatever this black swan event is, whatever is happening and burning a hole in the financial system. It's basically showing us how bad it's going to get in the future. And, you know, typically this inverts a year or two before the crisis hits. So that is pretty predictable. And you can see during this time, every time that blue line has gone above the orange line, there's been a recession, there's been a crisis, and it's always happened before. It's always happened before the crisis / recession. So it's extremely predictable. This is one thing that I look at all the time. I think it's incredibly important to look at because, like I said, it's insider information. It's like a window into the financial system. We don't know what is happening in the financial system all the time, but we can look at this and you can see what is happening. So, this is not good. If people are willing to lend out money for 10 years at a lower yield than for 2 years, you've got to ask the question, why are they doing that? And they're doing that because they know something bad is going to happen. They know, they're extremely pessimistic about the future and what could happen in the future. And especially when you're looking at 10 years compared to 2 years. lending money out for 10 compared to 2, and you get a much lower yield than you would for 2 years. How does that make any sense? It doesn't make sense. So I think anybody who pushes back against this type of stuff, like the yield curve, obviously just doesn't understand simple math and can't put themselves in the shoes as if they were lending somebody money. Would they want a higher return for lending the money for 10 years versus 2 years? Of course you would. And it shows you also how pessimistic they really are, because the rate is like 3% on the 10-year right now. So if the rate is 3% on the 10-year, what does that mean? That means that they're also predicting inflation is going to come right back down, possibly deflation. And this is pretty much prediction of a depression. We're probably already in a recession. I mean, I think we can all agree that we're in a recession. Seeing the consumers' behavior right now, people can't even afford to put food on the table. I mean, it's an outright crisis and recession that we're seeing right now. We just haven't seen the unemployment that comes along with a typical recession, because that always lags, and people forget that that always lags and comes later. So we're likely going to see that in 2023. And that is when, of course, the massive, monumental amount of stress would be put on the banks, because all that money that people have borrowed for the past 30 years and they can't afford to pay back, all those chickens come home to roost and it's game over. So really, you have to continue monitoring this, and we will continue monitoring this. But I just wanted to bring you this because I feel like it is so important to understand. So if you enjoyed this video, then maybe check out that video there, maybe check out that video there, and I will see you guys in the next one. Thank you so much for watching. Watch out for those imposters in the comments, and I'll see you.